things the other way with the markets in the background. So let me just go ahead and start it off. So this is going to be some of Rob's key trading rules, things to think about, things to know. Okay. Okay, just a reminder, since this is a kind of a formal presentation I'm doing here, and it's something you guys have seen this on my website. I talk about this all the time. Anybody that's seen my videos, I talk about the risk as much as the reward. Everybody always focuses on the reward. I focus on the risk. So make sure you take time to go ahead and understand this. If anybody wants a copy of this, I'll be happy to go and email you a hard copy of this. Okay, that's important. I always talk to you guys here about talking to a registered financial representative, developing a risk trading plan, and make sure you're trading according to that plan. When everybody went ahead and oh, absolutely, Ton. There we go. I always talk to everybody about going ahead and making sure you have those. When you sign up with me, you get a little risk trading plan development video and PDF file. And, of course, everybody should always consult the registered financial representative. So keep that in mind. Also, I have to say this, especially in light of the current environment, make sure you understand this is my work. This is my property. Any video output of this is mine. Please don't rebroadcast it anywhere. I'm asking you firmly and legally not to rebroadcast this anywhere. So this is for your personal use only. Okay. Now, as we start out, the first thing I want to go ahead and talk about is some of my key thoughts for my trading, and these are high level and they may seem like common sense, but if you think about how many times you've broken these rules, I can think of how many times I've broken these rules in the past, and I usually say, you know what, when I do that, it's cost me money. So I want to go ahead and focus on that to start. The first thing is capital preservation is first priority. In other words, I take less trades and I try to stack more probabilities in my favor. If I don't have those probabilities in my favor, I back off. Now, I did a whole lot of trading. There was a Thursday a couple weeks ago, 2 or 3 weeks ago on a Thursday, where the euro was in a really nice downtrend, and I just kept shorting the heck out of that thing. I had like 5 trades, in total for that day. And we had a nice downtrend. We kept going after it, and going after it, and going after it. Okay, but when you're in a sideways trend or a counter trend type situation, or you're thinking about taking trades against the trend, those are really low priority or probability, and you need to think about is that going to be good for my capital preservation? Capital preservation should be first and foremost. What most traders do is they come into this business with the get-rich-quick mindset, and I know there's a lot of websites out there that profess that. You don't see any of those big houses, fancy cars, fishing boats, whatever, yachts on my website, okay? Trading is not easy. It takes time, and it's a skill to develop. And but a lot of places, I get the emails myself all the time, the junk mails from the Traders Expo and that. Quit your job, fire your boss. All the other things that they say to entice you to want to go ahead and sign up with them. But I don't talk about that junk because it's not get rich quick. Okay, it takes effort, and so just keep in mind, capital preservation is the first priority, and trading is the second priority. Okay, never take a counter trend trade. Only trade with the trend. I very seldom, very, very, very seldom, do I ever make money in a counter trend environment. Okay, I mean, you're basically the laws of probabilities as you think about it. You're trading against the trend. Okay, there are ways to counter trend trade. I still don't think they're nearly as consistent. Some of my indicators that will be coming out will help with that process a little bit. But for my personal trading, the way I like to trade is going to be with trend, and that's even if the higher time frames like the hourlies are sideways, I need those 5-minute, 15-minute charts to be with trend. Okay, so there is a way to do it, but just understand that generally taking a counter trend trade is higher risk, lower probability. for me, a rule is I'm not going to take a counter trend trade, okay? I'm mostly profitable when trading with the trend only and scaling into a trade if necessary in the direction of a solid trend. When I start scaling in a sideways trend, well, anybody that's been here, has seen what, the results of that can be, okay? No adrenaline trades, okay? It may be painful to wait for a setup, but is the right thing to do. And, somebody here made the comment, the other day, well, I'm here, I feel like I need to be doing something, was a very interesting comment. And it's very true. I feel the same way, okay? The same feeling happens to me. When I'm sitting here for several hours a day, I'm feeling like, okay, why are we here if I don't see a trading opportunity? Let's just call it a day and save us all a lot of headaches, okay? But then I'm like, well, but at least I want to be able to educate people, so I'm here. But I get frustrated because I'm like, well, because remember, my style of trading historically has been I'll sit there and walk away from the screen for several hours, or I'll go ahead if there's no setup, there's no opportunity, and then I'll come back and see if any trend is formed. Or I'll go out and I'll watch TV and I'll put the computer, off to the side, which is something I do at night. That's kind of a technique I mentioned, in the overnight session. That's something that I'll go ahead and I'll do in the overnight session, is I'll have the computer sitting up next to me while I'm watching TV, and then it's kind of sitting off to the side over on the right, and I look over it every once in a while and see if something's starting to take place, rather than staring at it tick by tick. Once you start staring at it tick by tick, you start to exhaust yourself. You start to almost talk yourself into, I have to take a trade. I have to take a trade, Other people feel, like I said, the sense of adrenaline, because even if you're losing in a trade, the body has those, natural responses, that adrenaline, and some people just literally feed off of it. They would either, they would rather take 20 losses, 20 scalps in a day than sit there and do nothing, because it hurts physically. It hurts them to sit there rather than going ahead and actually, being in a trade. Then they're feeling that adrenaline rush. Okay, and that's very true. It's very true. And so no adrenaline trades. The other thing is that's not really on here that I should have on here is, no revenge trades. They kind of go in the, the same vein there, but that should be on there as well. No revenge trading. Okay. The market, stole that money from me, I deserve it back, or I want it back, and then you run out there and you take some sort of trade that's a higher risk, lower probability, and then you lose on that trade. Now you're double in the hole, okay? So if you guys notice how I act when I lose on trades, I don't sit there and turn around and say, wait a minute, that market owes me that money right back. I'm going to get that all back in one shot, the next trade or whatever. The market owes it to me. I actually take a step back and I ease my way back into things, make sure my head's on straight, and make sure I'm following the rules. Because when I follow the rules, I do far superior to when I don't follow the rules. That's a fact. And so, never revenge trade. Just because you can trade, it doesn't mean that you should, okay? So just because you can take a lower probability trade doesn't mean you should, okay? All day long, low probability trades exist, all day long. But the question is, are you trying to go ahead and slowly accumulate wealth, or are you gambling, okay? Are you stacking the odds in your favor, or are you going ahead and just shooting with, the wild, wild west, whichever comes your way, okay? And I think this is something that's, very important to all of us. And by the way, if anybody has any questions, please let me know, and I'll try to answer them as we go along. But I would rather be out of a trade wishing I was in, which hurts in itself quite a bit, doesn't it? Watching a market, dramatically fall or dramatically rise, you missed it. But wouldn't you rather be out of that trade wishing you were in, instead of being in a trade wishing you never got into that trade in the first place? Okay? So keep that in mind. Okay. Now, I briefly touched on this morning. No trade times. This is something, these times are all in Eastern time. I want to go ahead and revisit this because Many of you that are newer have not seen this presentation, and I think it's important you see this all in writing here. I've done this for those of you that have watched some of my videos. I do talk about these no trade times, but let's just re-summarize them. The opening bell, okay, and the opening range. The times the market actually runs is not worth all the times you'll get stopped out. Even with the trend, the opening range is a higher risk area. Now, I've actually gone ahead and proven that time and time again here, just here in January. In fact, the first day of January was one of the 1 or 2 days this month, I believe, that we've actually had a rip-roaring day right at the open. Okay, Monday, January 4th, the market just shot off like a rocket. And then as we saw after that, several days, the market went ahead, would open up, violently push down, push up, push down, push up. Okay, typically, 1 to 3 times a day or a month, excuse me, the market will go ahead and actually have kind of that strong opening range rally. But out of the 20 days a month approximately of trading, that's not very high probability. So you get 2 or 3 days where it really runs your way, and then the rest of the time you get chopped up. In my experience has been that's not worth it. The risk reward there is not worth it. Okay. Also near root news releases, 8:30 news releases. A lot of people still ask me. I'm very surprised by this. It's kind of scary when you think about it. But I kid you not. And those of you that are here that have asked me this, please don't take offense. But if you think about it, you look back on it now, you can realize the risks that were involved. People will go ahead and sit there and say, Rob, why is the market moving every day at 8:30? Or why does it seem like the market moves every day at 8:30? Or I was in this trade at 8:30 and the market went crazy. Wonder what that was about. It is amazing how many people start trading. It doesn't matter, investing for that matter, and don't understand the news releases, don't understand, what's coming up in front of them, okay? Even if you're an investor, shouldn't you know when the earnings announcements are? Okay, well, when you're a trader, shouldn't you know when the intraday news is going to be there? And that's why we try to post that each morning in the newsletter. But also you should go ahead and search out other independent sites as well of information like forexfactory.com as an example, FXCM if you're trading the currencies. And again, I'm not endorsing any of those sites specifically. I'm just saying that they have some information there as far as when these news releases are. And of course, for me, the news releases are no trade times. Okay. And the bond closing time. Okay, the bond closes around 3 p.m. Eastern time, and plus or minus typically at least 5 minutes. Sometimes it's up to 15 minutes, but just as a broad rule, I say plus or minus 5 minutes before and after. But the reality is it does seem that up to 10 to 15 minutes before, at times, the market starts to go kind of wild before the bond closing time. Okay, so that's another area where I kind of avoid. Noteworthy speaking engagements by the president, the Fed chairman, or frankly any other economic type report or government agency or entity that is going to be published heavily on like CNBC. If they're pumping it up and they're saying, hey, President Obama will be speaking in a few minutes, or the Fed chairman will be speaking in a few minutes, and we're going to be covering it live for you here. Watch us at CNBC or whatever the case, or Fox News, or Bloomberg, whatever. Then that's probably something you want to go ahead and avoid, because if it's like that, again, see, on these times are Eastern time, so that's something to go ahead and keep in mind as well. Okay. FOMC reports. Now, FOMC reports, I usually like to go ahead and be out 30 to 60 minutes before and wait till 30 to 45 minutes or more after. Okay, you're welcome, Sam. So the FOMC report, that's something to keep in mind. And again, the chop that happens, watch that around the bond closing time. Then look for a trend at the rest of the day. and what that's talking about is the FOMC reports. Okay, the FOMC comes out, and around 1:15 my time, so 2:15 Eastern. Then up until about the bond closing time, you're looking for a lot of chop and volatility and whipsawing back and forth. And then what I try to do is see if a last hour trend ensues. Okay, and this was particularly nice up to a couple of years ago, where you'd have one or two, three moves. Okay, it was pretty consistent, 1, 2, or 3 moves, whipping back and forth, almost like opening range trade on the S&Ps. And then the market would break out in the last hour, and you'd have a continuation sell or a continuation buy opportunity. So I still continue to look for that, basically looking for the fake outs after the initial news, and then after the bond closing time, looking to go ahead and see if things smooth out directionally for a trading opportunity. Okay? All right, as we talk about trends, some definitions for the trends. The 5, the 15, 30, and 60-minute charts are what I usually call the short-term trend. Okay? The daily and the weekly charts are what I refer to as the intermediate trend, and the monthly and the yearlies are what I refer to as the long-term trend. Okay? The daily weeklies, which is the intermediate trend again, are most important charts, and because what they do is they kind of help. If I can get the daily and the weekly in place in a consistent direction, and then I go in and I get the short-term charts to align with them, that's the most powerful move. Why is that the most powerful move? Well, that's typically the most powerful move because when you got the daily and the weeklies in place, you're going to have accumulation on a larger scale level. Okay, you're not just going to be talking about, day traders and scalpers aren't concerned about those dailies and weeklies, but an institution that's got millions of dollars or hundreds of thousands of shares of a stock that they want to accumulate, okay, or a broad-based basket of an index or a sector that they want to accumulate. They can't just do it in 5 minutes. You just can't buy millions of dollars of stock, hundreds of thousands of shares of stock without going upsetting the market. So in some cases, these things are done over days and or weeks. And therefore, if you can align yourself with that kind of buying, in addition to then the shorter term buying, the hedge funds, the proprietary trading desks, okay, you start to align yourself with some of those shorter terms that are trading on 30-minute, 60-minute, 2-hour, 4-hour charts, okay? And then you get the short-term traders in there as well. You're getting your highest probability for the maximum amount of move in the shortest amount of time. So trying to align the dailies, the weeklies, and then right on down the time frames are best, and that's what that next line there says. Trades with that 60 through the 5 with the daily, weekly are best with trend trades. 60 through the 5 against the daily and the weekly are the worst because on a more macro level, it's a counter trend trade. Okay, so you're kind of fighting the daily and the weekly, and we're going to see examples of that now as we go back to our live charts just from here earlier this morning. Okay, we see on the dailies we've got downtrends. Okay, the weeklies aren't quite there yet, but on the dailies we've got downtrends, and yet on the on the day that this is being reviewed, and then at the same time we already saw a couple of different things like the Japanese yen, for instance, that was in an uptrend today. Well, and then look, it was going to have median resistance. All right, so having things that where the daily and the weekly are not ticking and tying with the 5 through 60-minute charts is going to lead to the most disruptive trade. Okay, because of the fact that you're going to have the battle, the forces of good and evil, the people that are accumulating on the weeklies versus the dailies against the people that are on the shorter term time frame. So the best trades are looking for all of those stars to be in alignment, as I call it. Trading during a transition from an up to down or down to up is very risky. It's best to wait for the market to roll over first, then trade. Okay, we see this. We see this live, in the trading room every day. When you're in the transition process, you get high volatility because you basically got a flattened trend and a market whips back and forth. Okay, it's much better to wait till it breaks out into its new trend to take that trade. Okay, and this is Ultra Key. 60-minute chart is a key tool for the intraday trend trading. No trend, you have to beware of snapbacks. I've gone ahead and proven that time and time and time again. Okay, we see it every day in these markets when we don't have the 60-minute trending. We see issues with that, those snapbacks, and they're very violent. They're very painful when you're on the wrong side of them. So for higher probability trades, again, we want the 50, the 5, the 15, 30, and 60-minute charts in the same direction of the trend as the daily and weekly. Again, I want to reemphasize that. Okay. Now, is that absolutely necessary? No, but what we're talking about here is I'm trying to differentiate highest probability from high probability to lower probability to lowest probability. Okay. Going with the daily and weekly, if you're going with the daily and weekly, you don't need the 60 and the 30, but it's better to have it also, okay? And what I'm referring to there is remember I said the 5 and the 15? If the 5 and the 15-minute charts are in like an accumulation phase, and the daily and the weekly charts are also in an accumulation phase, then at least I'm trading in the shortest term time frames with the highest term, okay, the more intermediate trend, okay. So the 30 and the 60, and that's where, guess where that comes in, Glenn, for you, that comes in with the scalping, okay. So that's one of those areas we'll be talking about when it comes time for the scalping trades, okay. Okay, thanks, Nick. Then if we're going against the daily and the weekly, then you go ahead and need the 60, 30, 15, and 5 to confirm, okay? So you see that here with me each day, where if we happen to be in a downtrend on the daily, I'll look at an uptrend in the market for a long. I'll look to go long, but only if that 60-minute is in an uptrend, okay? So hopefully that's going ahead and making sense for you there. The key is if the daily or the weekly is in a downtrend, but I happen to have a short-term uptrend on the 60-minute chart, and the 30s and the 5s and the 15s agree, then I will look at longs. But I need to have then the 60 and the 30 in place, as we talk about here each day. Particularly the 60. That's critical, especially if going against the daily and the weekly. Okay. If the 15, 30, and the 60 are not supporting the trade, look for quick profit before a snapback. Okay, so in other words, if we have sideways trends and we don't have everything going our way, basically you're looking for scalps. Okay, and so this is starting, Glenn, to already get into the formal presentation, which we'll do at a later time on scalping trades. Okay, but these are some of those things are starting to bleed in here. All right, so you're looking for quicker profits if you don't have the higher short-term trends in place, okay? So I do not like a long side trade when below the 60-minute 20-period moving average, and I don't like a short side trade above the 60-minute 20-period moving average, okay? The 60-minute chart that's sideways with a 20-period moving average and or greater than 50, 50 on the RSI, if you're in a short position, you should expect a snapback and losses. Okay, so in other words, if the market is sideways on the hourly charts, but the RSI is greater than 50 on the hourly chart, you got to expect that the market can whipsaw back up to the upside. So that's one of the reasons I have that RSI on the charts. Okay, that's one of the reasons we look at that. And if the 60-minute chart is sideways and the RSI is below the 50-period level on the RSI, okay, that 50 level, the scale is 0 through 100 on the RSI, and the 50 level is the neutral zone. So if the RSI is below the neutral zone, below 50, longs should expect snapbacks and losses as well. Okay, so the bottom line is, if you're long below the RSI, you could expect snapbacks back to the downside. If you're short above the the neutral line on the RSI, you should expect reversals back to the upside. Okay. If the 20-period moving average is flat, there's generally no trade. Okay, and that's generally the case. If there is, because a flat 20-period moving average itself can go either way, which leads to a 50-50 chance. So if you want to take a trade there, what I have to do is focus on the shorter term time frames, like the 5 and the 15 and that, and look for a confluence of the different averages in that, which we'll talk about in the scalping trades. But those are really designed then to be more scalping trades. Because if I got a flat trend, I'm trendless, I'm not going to be looking for the big move. Not going to be looking for the big kill. Okay. If there's no intraday trend, that's what typically causes me to lose money because there is no support for the trade. And if we think about that, just in my past trading, like I said, most of the time, my trades where I've lost money have been against the trend. Okay. Or in a trendless market where I try to scale in, but there's no support to this scale in, so it can easily whipsaw back beyond. So that's why, typically, very seldom do you ever see me break those rules, because when I do is usually when I lose money. So something important to think about. Okay. Now, 1 or 2 bars do not make a trend. You hear me say this all the time. Okay. Only bars not touching the 20-period moving average count. A trend with air and space between the price and the 20-period moving average are best. So you see me, as we look at the hourly charts, I only count the bars when I'm looking for those 6 bars of air, ideally, from the last bar that has not touched the 20-period moving average. So less than 6 bars equals a junior trend, and that's actually 3 to 5 bars in particular. Okay, 3 to 5 bars is a junior trend. 6 to 8 bars is a senior trend. It's ideal. Okay, after 8 bars, I start worrying how far, has the trend gone too far? Is there going to be a pullback? Okay, a significant pullback. But that 6 to 8 bar range is kind of ideal. 1 to 2 bars is not a trend. So you see 1 to 2 bars is still no trend. 3 to 5 bars is a junior trend, and 6 bars or more is a senior trend. Okay, so you need the 6 to 8 bars for a good trend. Strongest if the bars are not touching the 20-period moving average. Those are really the only ones I count. And the 15-minute is in a trend first, and then the 5-minute resumes the trend direction. That's what I call a speed line continuation trade. There's actually several variations of that. I've got a whole video on trend trading, of course, but you're going to learn a little bit more about that as we go forward. For those of you that do the scalping here, that'll certainly be something that you're going to be interested in. Okay, so because if we don't have that strong trend, I still use some of those techniques to go ahead and look for the scalping trades. Okay, so I'm asking myself, what is the quality of the trend? Is it 6 or more bars? Is it going ahead and is there air there? Okay, between the price and the moving averages, and what I'm looking for is to watch out for Swiss cheese. You guys, have seen me talk about that constantly, where we're talking about moving averages being punctured back and forth, back and forth, back and forth with the price. So what I say is that's poking holes in the moving average, and it stinks. So that's why I call it Swiss cheese. Okay. And how many times have we done that? Now you saw me go ahead and look at that. Each morning when I'm gauging the quality of a trend that's still in place, I look at the 5 and the 15 and the 30 minutes, and I ask, how many times have they been punctured? How many times have they gone ahead and closed above the moving averages in the opposite direction, or below the moving averages in the opposite direction? Okay. So that's something really important to go ahead and note there. That's how I determine, it's a Swiss cheese, but also the quality still of a trend. Okay, the 60-minute can look like it's in still an uptrend or a downtrend because it's got 6 bars of air. But if we go ahead and we look at the 5, 15, and 30, we see they've had several closes above or below their moving averages in the opposite direction to the 60, we start getting worried that we're in the process of having a trend change. Okay, Sam, could you clarify what is that? You said, is this for all time periods or just 60 minutes? For which thing here? The 6 to 8 bars, Sam, is typically in relation to all. But when I'm gauging the top tier of the trend on an intraday basis, the 6 to 8 bars is equally important probably for all of them. When I'm going ahead and looking for a scalping trade, I'd like to have ideally 6 to 8 bars on the 5-minute chart and the 15-minute chart. Okay, but when I'm going ahead and focused on the overall direction on the day, I'm focused on, okay, Nick, that's great, that's good news. When I'm focused on the more macro intraday trend, then I'm really looking more towards the hourly. So it's what we're looking for, Sam. The question is, are we looking for the overall direction for the next several minutes and hours, or are we looking for the next few minutes for a scalp? Either way, the same rules will apply, but depending on the nature of what kind of trade I'm looking for will depend where I'm looking. And so, Glenn, you're getting kind of a flavor there for what some of the things we're going to be talking about as it relates to the scalping. Okay? And again, we're not going to cover the scalping today. That wasn't the intention of this. In fact, quite the opposite. Today, I'm really just focusing on trends, but you can see that some of this information is going to transcend then into the scalping arena. Okay?